Last time I told you about 84-month loans. Today, it's about why your brain doesn't even notice the cost. You sit down at the dealership. The finance manager slides a paper across the desk and asks one question. What monthly payment were you hoping for? Not what price were you hoping to pay, not how much do you want to borrow, just the payment. And almost nobody in that chair notices the trick has already started, because the human brain evolved to solve a completely different kind of math problem than the one being asked of it. Here's the belief almost everyone walks in with. A car loan is just a delayed price tag. You still pay for the car, you just pay for it a little at a time. So really, nothing has changed except the timing. That belief feels obvious. It also happens to be almost entirely wrong. And the reason it's wrong is not a financial reason. It's a biological one. To understand why, you have to go back roughly 200,000 years, long before money existed, to the brain that's still running the show every time you sign a financing agreement. That brain was built to answer one question extremely well. Is this good for me right now? It was never built to answer a second question that modern life demands constantly. Is this good for me over the next 6 years? There was no such thing as a 6-year problem on the savannah. A threat was either in front of you or it wasn't. A reward was either available today or it may as well not exist. Evolution optimized for the immediate, because the immediate is what kept you alive long enough to have descendants who think the way you do. So when a lender reframes a $43,000 vehicle as $763 a month, they're not lying to you. They're doing something more effective than lying. They're translating a 6-figure, multi-year decision into a small, single, present tense number your ancient reward system already knows how to evaluate. 763 feels manageable. It feels like a subscription, like a phone bill, like something your monthly paycheck can simply absorb without a fight. 43,000 feels like a threat. Your brain was never going to compare those two framings fairly, because it isn't built to unify them into one judgment. It evaluates whichever number is put in front of it, and the number put in front of you is always the smaller one. This is the first piece of the mechanism. Monthly payment framing doesn't just make a big number easier to swallow. It actively prevents your brain from running the comparison that would make you cautious. Behavioral economists have a name for the broader pattern this belongs to: narrow framing, where a decision gets evaluated in isolation from its true scope. The dealership isn't inventing a new trick here. It's exploiting a bug that was already built into the operating system. Now watch what happens next, because the second mechanism is even sneakier than the first. Once you accept a monthly number instead of a total price, the lender has a second lever to pull: term length. And this is where the loan quietly stops being about the car and starts being about your attention span. Stretch a loan from 5 years to 7, and the monthly number drops in a way that feels like relief. Industry data on new vehicle financing regularly shows loans of 72 months or longer now make up a large and growing share of all auto purchases. And the reason is exactly this instinct. When the sticker price climbs, buyers don't push back on the price, they push out the timeline. From a caveman brain's perspective, this looks like a pure win. Smaller monthly threat, same shiny reward. What's the catch? The catch is that stretching the term doesn't just spread the same cost across more months. It changes the total cost, because interest accrues on whatever principal is still outstanding, for as long as it stays outstanding. A shorter loan attacks the principal aggressively, and interest has less time to compound against you. A longer loan lets a much larger chunk of your balance sit untouched for years, quietly generating interest the entire time. Data compiled by J.D. Power on financing patterns shows this plainly. Borrowers who stretch into 84-month terms pay meaningfully higher interest rates than those on 60-month terms, not lower. The safer, smaller payment option is frequently paired with the worse rate, a double cost that never shows up in the number the salesperson says out loud. Here's where the story usually takes its darkest turn. And it's the part almost nobody sees coming until they're already inside it. Negative equity. This is the mechanic that actually explains why the title of this piece calls the loan a trap, not just a bad deal. A new car begins depreciating the moment it leaves the lot, often losing a substantial chunk of its value within the first year alone. Meanwhile, on a long loan, your early payments are mostly interest, not principal, so your balance falls slowly, while the car's value falls quickly. Picture two lines on a graph. One line is what you owe. The other is what the car is worth. On a short loan with a real down payment, those lines cross quickly. And for most of the loan's life, you owe less than the car is worth. On a long loan with little or nothing down, those lines can take years to cross. And for a painfully long stretch, you owe more than the car is worth. That gap has a name: negative equity, or being underwater. And the data on this in 2026 is not a rare edge case. Roughly 3 out of every 10 trade-ins toward a new vehicle purchase now carry negative equity, according to auto industry analysts at Edmunds, with the average underwater balance sitting in the thousands of dollars, a record high for the period. Ask yourself what that means in plain terms. Nearly a third of people walking into a dealership to upgrade their car are actually walking in already owing money on a car they no longer have. This is where the caveman brain does something almost unbelievable, and it's the emotional core of the whole trap. When someone is underwater on their trade-in, the rational move is obvious. Keep the old car a little longer, or accept a smaller trade-in credit and pay off the remaining gap in cash. But the ancient reward system doesn't process "your old commitment is bleeding you slowly" as an urgent threat, because slow bleeding was never a survival-relevant category. What it does register as urgent is the shiny, new, immediately available reward sitting on the showroom floor right now. So instead of resolving the old debt, buyers frequently roll it directly into the new loan, folding yesterday's mistake invisibly into tomorrow's principal. Analysts tracking this pattern have found that buyers who roll negative equity forward end up paying dramatically more in total interest over the life of the new loan than buyers who don't, often thousands of dollars more, because they're now paying interest on a car they own, plus interest on a car they no longer own. Notice what's happened by this point in the story. The loan was never just the price of the car spread out. It became a payment-sized illusion, stretched across a term long enough for depreciation to outrun repayment, occasionally compounding into a debt that survives the very asset that created it. None of this required anyone to make an unusually foolish decision. It only required a brain that evaluates the number in front of it, rather than the shape of the whole 6-year commitment behind it. So why doesn't the "it's basically free" feeling ever correct itself, month after month, as the bills keep arriving? This is the third and final piece of the mechanism, and it's the quietest one. Humans are extraordinarily good at mental accounting, sorting money into separate mental buckets rather than treating it as one interchangeable pool. The car payment gets its own bucket. It becomes a fixed background hum, budgeted around rather than actively reconsidered, the same way a subscription you forgot you had keeps auto-renewing. Once a cost becomes routine, the brain stops flagging it for review. It moves from decision to environment, and your ancient threat detection system was never built to keep scanning the environment for slow-moving problems it has already filed away as normal. Put those three mechanisms together: payment framing that hides the true price, term length that hides the true interest cost, and mental accounting that hides the ongoing bleed, And you get a strikingly consistent modern pattern. Millions of financially reasonable people carrying auto debt that quietly outlives the value of the thing it paid for, without any single moment where it felt like a mistake was being made. Which brings us back to the dealership desk and the finance manager's question. What monthly payment were you hoping for? It was never really a question about your budget. It was a question precision engineered for a brain still wired for a world with no such thing as compound interest, no such thing as an 84-month commitment, and no experience whatsoever evaluating a decision whose consequences unfold slower than a season change. The caveman in your skull isn't stupid. He's just answering a question he was never built to be asked. And the only real defense is doing what he can't, stepping back from the monthly number entirely and asking what the whole 6-year story actually costs. If this changed how you think about something you thought you already understood, that's the whole point of this channel. If you enjoyed it, drop a like and subscribe. It genuinely motivates me to keep making videos like this. And if you've got a topic you want broken down this way, drop it in the comments. I read all of them.